Sam Altman recently admitted something no Silicon Valley founder ever wants to say out loud. He said this entire AI boom might actually be a bubble. Not in a vague academic sense, but in the way .com was a bubble, when companies raised billions without ever shipping working products. He compared today's frenzy to that era, and the comparison isn't flattering. During the .com years, startups promised digital revolutions and delivered broken websites. Today, CEOs promise AI revolutions and deliver half-working chatbots that mostly hallucinate. The hype feels massive, but the substance feels smaller than advertised. Stock markets don't care about substance, though. They care about stories, and nothing sells like a story about replacing human intelligence. The U.S. market nearly doubled in just 5 years, mostly powered by investors betting big on companies saying the word AI in every presentation. Share prices ballooned, sometimes adding hundreds of billions to valuations overnight, even though the products remained smoke and mirrors. It's like evaluating a restaurant not by the taste of the food, but by how expensive the forks look. Numbers on screens keep climbing, but the real question is whether anything useful is actually being built. When investors pile into a stock, it doesn't mean money appears from thin air. It just means the last buyer paid more than the one before. If one banana sells for $10, that doesn't magically make every banana on Earth worth 10. It just means somebody overpaid for fruit. That's how bubbles form. A few transactions at inflated prices make everyone else believe they're suddenly rich. Except eventually, somebody tries to sell, and the whole illusion collapses. That's the fear creeping into the AI space right now. The valuations are sky high, but the tangible value isn't keeping pace. So what did we actually buy during this frenzy? Not knowledge, not productivity miracles. What we really bought was hardware, a mind-bending amount of metal, chips, and power plants. Amazon, Meta, Google, and Microsoft alone dropped around $340 billion on AI infrastructure in a single year. That's about 1% of America's entire GDP, spent on just racks of GPUs, concrete data centers, and endless cooling systems. It's infrastructure on a scale normally reserved for national wars or space programs. And that's just the visible spending. OpenAI itself has raised tens of billions, with Altman casually suggesting trillions will be required to keep scaling. Trillions, as if that word doesn't instantly bend reality. China isn't staying quiet either. State-backed companies there reportedly spent around $500 billion on their own AI build-outs. Add in the rest of the world's chip purchases from Nvidia and AMD, and the global tab already clears $1 trillion. That's $1 trillion before counting electricity, staff, or bandwidth. Just the hardware alone could fund entire national infrastructures. But right now it's mostly being funneled into GPU farms producing cat poems and synthetic Drake songs. We're burning money faster than rockets leave Cape Canaveral, and the returns look strangely small compared to the input. All this infrastructure demands power. Real physical electricity that doesn't magically appear when you whisper cloud. Today, data centers already consume about 1.5% of global electricity. If current growth continues, that figure could double by 2030, which would make AI one of the most voracious power hogs in human history. Think about that. We might face blackouts not because of electric cars or air conditioning, but because someone wanted ChatGPT to roleplay as a medieval wizard. The US grid in particular looks terrifyingly unprepared. Most of it was built in the 1960s and limps along with barely 15% reserve capacity. That means if AI keeps scaling, parts of the country could flicker like old fluorescent bulbs. Meanwhile, China built a much newer grid with around 100% reserve capacity. They can plug in millions of GPUs without instantly stressing their system. The US can't say the same. We're already seeing hints of stress in energy bills. American electricity prices nearly doubled over just 3 years, partly thanks to data centers competing with everything else for power. That means every grocery bill, every factory line, every household light switch indirectly subsidizes somebody's chatbot query. Goldman Sachs analysts project meaningful new power capacity won't arrive until late this decade. Until then, we're trying to jam supercomputer clusters into a grid already gasping for air. Vacancy rates for data centers are under 3%. There's literally nowhere left to plug in the future.
So maybe the bigger issue isn't hype. Maybe the bigger issue is logistics. Imagine telling investors you'll build the next industrial revolution, then realizing your extension cord doesn't reach the outlet. That's the vibe right now. Even if the software worked perfectly, we'd still be bottlenecked by real-world constraints. And the truth is, the software doesn't work perfectly. Not even close. Reports keep finding that 90+% of businesses adopting generative AI see no meaningful return. Zero return, not just disappointing margins. The demos wow executives, but the moment you put these tools inside real workflows, they collapse like IKEA shelves in a storm. They hallucinate, they contradict themselves, they drift off task. The hype promised office revolutions. The reality looks more like expensive spell check with better PR.
The rare companies seeing value aren't trying to automate everything. They quietly target one narrow process like invoice handling or contract reviews and shave hours off paperwork. No flashy co-pilots, no AI running the entire firm. Just small, boring efficiency gains that barely make headlines. Meanwhile, startups insist on selling co-pilots for every human job, from HR managers to wedding planners. The tools break constantly, clients lose patience, and the cycle repeats. It's a bubble dynamic, too much money chasing too many half-working ideas.
And here's the cruel irony. AI was supposed to fix coding itself. Remember that? Developers cheered at the idea of machines writing clean, fast, bug-free code. Instead, teams now hire AI janitors to sweep up the mess the models generate. Output full of bugs, security gaps, and convoluted spaghetti logic. Instead of replacing engineers, we just created a new subclass of engineer whose only job is cleaning up after robots. It's a paradox worthy of a sitcom, but it also shows how fragile the current hype really is. Even worse, the platforms themselves aren't stable. They change so quickly that developers building on them constantly lose progress. A new update can break months of integrations overnight. Imagine if Apple released an iPhone update that suddenly removed the App Store. That's what it feels like building on top of these constantly shifting AI APIs. Nobody can confidently plan for 5 years because the ground keeps shaking under their feet. Startups vanish not because their ideas were terrible, but because their foundation got yanked without warning. So why keep throwing billions at a system wobbling like a toddler on ice skates? Because nobody wants to be the one who missed the future. The psychology is as important as the technology here. CEOs saw competitors slap AI powered onto everything and watch stock prices jump. Nobody wanted to be the dinosaur left out of the party. Budgets were rewritten overnight, entire departments rebranded, strategy memos filled with buzzwords. It became less about results and more about optics. It didn't matter if the AI worked, as long as the market believed you had AI. That's how bubbles grow, not from logic, but from pride and fear. The same script played during the dot-com years. Companies added .com to their names and instantly doubled valuations, even if they never shipped software. Investors didn't care about profits, only about being present for the next internet. Today's story is nearly identical. Swap .com for AI, and the pattern repeats. The technology itself is real, but most companies using it probably aren't. Sam Altman calls it a kernel of truth wrapped in hype. The internet was transformative, but most .com startups vaporized. AI will probably follow the same arc. The real survivors will be boring, unsexy firms building infrastructure, not the flashy consumer apps making headlines. Meanwhile, workers get caught in the fog. Young professionals especially worry that AI has stolen their jobs. Every week, headlines scream about automation replacing roles, fueling fear across industries. But much of the hiring slowdown stems from companies correcting their own pandemic overhiring sprees. Firms hired too many developers during lockdown, then froze recruiting once the bubble cooled. Layoffs weren't robots taking over desks, but executives trimming back excess staff. AI became the scapegoat for structural corrections that would have happened anyway. Fear sells, so fear kept spreading. That combination of ego, FOMO, and anxiety is the oxygen feeding the fire. Investors keep funding shaky startups, workers keep fearing displacement, and the cycle loops. Silicon Valley thrives on stories, not proof. And nothing is a better fundraising story right now than we're building the future with AI. Venture capitalists, who once funded $400 million juicers, now call this the biggest private tech bubble in history. They admit it openly, but still keep writing checks. Private valuations let the bubble grow even faster because there's no daily stock chart to reveal cracks. A startup can raise billions, lose it all, and raise again at a higher valuation if the story still sells. But most of this wealth isn't spread evenly across the market. It's concentrated in maybe 10 mega-cap firms like Nvidia, Microsoft, Amazon, and Meta. These giants tied their fortunes directly to AI spending, and their stock prices ballooned accordingly. Analysts now whisper that spending will soon slow, and when it does, those inflated prices may tumble. The center of gravity feels precarious, a few giants holding up an entire skyscraper of hype. If they stumble, the ripple could cascade through markets everywhere. History tells us most of this will collapse. Bubbles don't destroy everything, but they destroy most things. After the dot-com crash, thousands of startups vanished overnight. Yet a handful survived and built the backbone of today's internet. Google, Amazon, eBay, all born from rubble. AI's future will probably rhyme with that story. Thousands of flashy generative startups will vaporize, but some boring survivors will emerge stronger. Those survivors will be the companies building chips, constructing data centers, upgrading power grids. The plumbing of the AI world, not the face filters or novelty chatbots. The foundation, not the glitter.
And that's the paradox that makes this bubble fascinating. It will burst, but what remains could shape the next 50 years. The destruction will be ugly, but the survivors might define the real technological era. We're standing at the uncomfortable intersection between irrational exuberance and genuine innovation. The bubble isn't just financial, it's psychological, cultural, infrastructural. And somewhere inside this noisy mess lies the quiet truth waiting to emerge. The strange thing about bubbles is how rational they feel from the inside. Everyone tells themselves this time is different, that the rules of economics have been rewritten, and that old lessons no longer apply. The dot-com era had the same energy, with analysts insisting clicks mattered more than profits and valuations could expand forever. Today we hear similar refrains about AI, with boosters promising intelligence is the new oil, and dismissing every skeptic as short-sighted. But economic gravity always returns eventually, and when it does, the fall feels brutal. The big question is how far AI has to drop before it finds stable ground. The first place to watch isn't the flashy startups or the trendy apps. It's the hardware makers, especially Nvidia. That company became the poster child of the AI boom, selling specialized chips that power nearly every major data center build-out. Their stock price skyrocketed on demand that seemed bottomless, making them one of the world's most valuable companies almost overnight. But chip cycles are famously volatile. When demand dips even slightly, inventories pile up, prices collapse, and entire industries wobble. If AI hype slows, Nvidia could swing from market darling to cautionary tale in months. The same happened with Cisco during the dot-com era, when once insatiable networking demand suddenly evaporated. Another critical pressure point is energy. Electricity isn't optional for AI growth, it's the lifeblood. Without cheap, abundant power, these giant clusters grind to a halt. That makes AI uniquely vulnerable to energy shocks. If natural gas prices spike, or if climate events strain grids, the economics of AI crumble quickly. Companies can't justify billion-dollar data centers if running them costs more than the software earns. Some analysts warn that electricity prices might become the hidden governor of AI's trajectory, constraining growth regardless of investor enthusiasm. A trillion-dollar dream can't survive without functioning sockets. Then there's the regulatory front. Governments tolerated social media growth with almost no oversight, but AI carries sharper risks. National security, misinformation, intellectual property, labor, every category attracts regulators. In the United States, lawmakers already float proposals for licensing advanced models. auditing training data, and restricting export of high-end chips. Europe moves even faster, drafting sweeping rules on transparency and accountability. Each new regulation slows momentum, adds compliance costs, and creates uncertainty. Investors hate uncertainty. If governments tighten the leash too quickly, capital could flee to safer bets, puncturing the bubble earlier than expected. The other overlooked risk is cultural fatigue. People are already complaining about AI everything saturating daily life. News feeds filled with generic summaries, art platforms overflowing with derivative images, endless AI-written spam cluttering inboxes. The novelty wears off fast, and what's left is annoyance. Consumers don't want every product to be AI-enhanced if the result is worse experiences. We saw the same fatigue during the 3D TV craze when every manufacturer forced the feature even though few households wanted it. The hype burned bright, then collapsed overnight when nobody cared anymore. If AI becomes synonymous with irritation rather than delight, adoption slows sharply. That doesn't mean AI itself vanishes. The core technology is real, powerful, and improving rapidly. What changes is the context around it. Instead of being a magic wand for every problem, AI may settle into narrower, quieter roles. Think of cloud computing. At first it was marketed as revolutionary, a concept destined to transform every business instantly. In reality, it took years of boring infrastructure work before companies integrated it meaningfully. Today, the cloud is indispensable, but nobody markets it with the same drama anymore. AI could follow that arc, from hype storm to invisible backbone. One of the quiet survivors will likely be semiconductor companies. Not just Nvidia, but also AMD, Intel, and emerging firms in Asia. Chips are tangible assets with clear demand curves, and their utility extends far beyond language models. Autonomous vehicles, robotics, biotech simulations, weather modeling all require the same computational muscle. Even if generative hype cools, the appetite for high-performance chips remains. Investors burned on overhyped startups may redirect capital toward these boring but essential manufacturers. The companies that build shovels often outlast the ones chasing gold. Another survivor class will be data center operators and power grid specialists. Right now, vacancy rates hover near zero, meaning demand far outstrips supply. Even if growth slows, the world will still need massive storage, compute, and networking. Expanding that capacity requires expertise in cooling systems, fiber layouts, and regional grid negotiations. These aren't glamorous sectors, but they form the plumbing of the digital economy. During the dot-com collapse, many flashy portals died, but infrastructure firms quietly expanded. The same dynamic may unfold here, with energy utilities and server farms thriving while consumer apps fade. For startups, the path looks harsher. History suggests 9 out of 10 will vanish. The survivors won't be the ones promising to reinvent human creativity or replace doctors entirely. They'll be the ones picking very specific, unglamorous niches, automating back-office paperwork, improving logistics routing, optimizing insurance claims. These sound boring compared to AI poets or talking avatars, but boring often wins. Investors may eventually tire of moonshots and embrace companies quietly shaving costs in industries everyone ignores. It won't make headlines, but it will build resilience. A subtler question is what happens to talent. Right now, AI researchers command extraordinary salaries, often in the millions. That's sustainable during a hype cycle, when capital flows freely. But if the bubble pops, demand for elite AI talent could shrink dramatically. We've seen this before with blockchain, where six-figure offers evaporated once token prices crashed. For young engineers betting careers entirely on generative AI, the risk is real. The field will persist, but the salaries and prestige might deflate. Some of today's AI rock stars could find themselves scrambling in a few years. Yet there's also an opportunity buried in the rubble. When bubbles burst, resources free up. Office space becomes cheap, hardware floods secondary markets, and talent searches for new projects. That's when real innovation often begins. The dot-com collapse cleared the way for the companies that eventually built social media, cloud computing, and e-commerce. The wreckage of this AI bubble might seed breakthroughs in areas we can't even predict. Maybe fusion energy companies scoop up idle GPUs for simulations. Maybe biotech firms harness cheap clusters for drug discovery. History shows the leftovers often matter more than the hype itself. So what should we actually watch for as the turning point? The first warning sign will probably be funding rounds drying up. When venture capitalists stop reflexively throwing billions at every AI startup, the air starts leaking from the balloon. Next comes public market corrections, with mega-cap firms announcing slower spending and investors panicking. After that, layoffs spread, glossy conferences thin out, and suddenly the narrative flips. Instead of endless optimism, headlines shift toward disillusionment. Gartner calls this the trough of disillusionment, and every technology cycle passes through it. AI won't escape. But the trough isn't the end. It's the beginning of something sturdier. When hype fades, expectations reset, and builders focus on solving real problems rather than chasing valuations. That's when the kernel of truth shines through. AI can process information faster than humans. It can uncover patterns in data we'd miss. It can assist with repetitive tasks that waste time. Those strengths won't vanish, but they'll find humbler applications. The revolution won't be about replacing human intelligence wholesale. It will be about augmenting it quietly, invisibly, in places where it actually matters. The cinematic irony is that we may look back on this era with both embarrassment and gratitude. Embarrassment at how wild the hype became, how many fortunes vanished chasing vaporware, how many promises collapsed under scrutiny. But gratitude for the infrastructure left behind, the chips, the data centers, the expanded power grids, that future innovators will inherit. It's like ancient civilizations building monuments they couldn't sustain, leaving ruins that later societies reused. Our AI bubble may crumble, but its ruins could become the foundation of the next age. The real question is what role humanity plays in that next age. Do we treat AI as a co-worker, a tool that enhances productivity, or do we continue fantasizing about digital gods? Do we build responsibly, with attention to limits and costs, or repeat the cycle of hubris? Those choices matter more than stock prices or venture rounds. Because behind every model and every dataset lies the same reality: human intelligence building tools to extend itself. Bubbles burst, but intelligence persists. And when the dust clears, we'll see not just what AI built, but what it forced us to confront about ourselves.